I understand that everyone's now present online. So the first order of business is to adopt the proposed agenda. Are there, excuse me, are there any comments or additions to the agenda? Hearing none, then may I have a motion to adopt the agenda as presented?
So moved.
So moved.
Okay, that was a move and second. All in favor, say aye.
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 All opposed, say no. Okay, so we've adopted the agenda. The next order of business is the vote to approve the March and April meetings as presented, as you've read. And are there comments or additions that you would like to make before we adopt before we approve the minutes?
Mr. Chairman, we did receive some additional comments from Mr. Condon last evening, which I believe were sent to you, me, and Betsy. We reviewed those, and I mean we're prepared to add those comments to and it's in regards to the April minutes, and we're prepared. We have those ready and are prepared to incorporate those into the minutes if that's the desire of the commission.
Okay, and Bill Condon, would you just sort of tell us the nature of your additions to the April minutes?
Yes, sir, Mr. Chairman. Thank you, and thank you too, Mike. Yeah, both relate to page 3 of the April 16 minutes, where it talks about our discussion about the COP that we approved that day, and I wanted to make 2 changes. One was to add several sentences that gave detail about, or really in a summary form, but detail about my comments. The minutes as they were stated, as they were drafted, just said I had some questions and I wanted to provide some more specificity. And then so adding 4 sentences in the middle of that 4th paragraph on page 3, and then I think it's the 3rd sentence in that paragraph. It said that I had some questions, and I would characterize them more as concerns. So my second change was just changing the word questions to concerns. And I can read the additional sentences if the commissioners would like me to. But as Mike said, the chairman and Mike and Betsy have them to add.
Yes, and Mr. Chairman,
I can make a motion if that's needed.
Yeah, and Mr. Chairman, as I said, we reviewed those minutes. Reviewed those requests for additions, and I believe, they're consistent with the points and that Mr. Condon raised during that discussion.
Okay, so Bill Condon, if I may, I would just add that in effect you are adding comments related to the reasons why you voted against the adoption of the SIOP AIP. Is that fair?
Yes, sir, that's fair.
Okay, are there any objections to adding these sentences to the April minutes?
I don't mind adding them, but I'd really like to know what they were before I vote to approve them.
Okay, can those be shown on the screen?
Red. Yeah, would it be okay? They're relatively short, Mr. Chairman. Would it be okay if I just read those? I'm sure
that's fine. Sure.
Yeah. I'm sure that there is a technical way for me to do that, but hold on.
Yes, reading them is fine.
Yeah, they're relatively short. Mr. Chairman, what Mr. Condon is recommending is adding the following after the second sentence in the fourth full paragraph on page 3. Page 3 is should be up on your screen. And what it would say is Mr. Condon stated that the proposed SIOP that we are considering today includes some great improvements from the SIOPs of prior years. However, he stated he does not support this SIOP as a whole. He stated that the SIOP is the foundational document of this agency, but he believes that it is not ready for adoption and that additional work must be done to make it ready for adoption. Mr. Condon stated that the proposed SIOP does not clearly identify and fully document all of the decisions necessary to change our asset allocation and entire investment framework, and that the matter that caused the commission not to consider the SIOP at its March 2020 meeting showed that our process in adopting a new investment framework was incomplete. That's the suggested language. And then, as Mr. Condon said in the third sentence of that paragraph on page 3, he just wanted to change the word questions to concerns.
Okay, further comments about these additions? Or further objections to their being added? Okay, then the April minutes that we vote on will include those additions to the April minutes. So let's vote on the March and April minutes separately. All in favor of approving the March 2020 minutes, say aye.
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 All opposed, say no. Okay, then for the April minutes as amended, all in favor of approving the April minutes, say aye.
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 All opposed, say no. Thank you. We have approved the March and April minutes. Okay, the next item of business is the chair's report. And you will recall that we call for nominations for the chair and vice chair for the next 2 fiscal years at the April meeting. And the nominations presented at that meeting were for Bill Hancock as chair and Ron Wilder as vice chair. Are there any further nominations for those 2 positions? Okay, hearing none, then the motion is to elect Mr. William Hancock to serve as chair and Ron Wilder to serve as vice chair of the commission for the term commencing July 1, 2020 and ending June 30th, 2022. All in favor of the motion, say aye.
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 All opposed, say no. Thank you. We have a new, or at least partly new team as chair and vice chair. So congratulations, Bill Hancock. I look forward to serving with you for the next 2 years. And let me just say that as my term of chair comes to an end, June 30th, I'd like to thank all of the commissioners for your teamwork and cooperation during the past 2 years. And I thank you, Rebecca, for your service as vice chair, which has been very helpful to me. And of course, I thank Mike, Jeff, and the entire staff for your excellent support during these 2 years. Thank you very much.
Thank you, Mr. Chairman. Thank you for your steady hand on the tiller for the past 2 years. It's been a pleasure to serve with you as chair. And I look forward to continuing to serve your continued service as vice chair, and look forward to working with Mr. Hancock in his new capacity as well.
Ditto from me, guys.
Well, thank you. This is a change, but not a change in excellent operation of the commission that we've been enjoying. Okay, the next item of business is a report of the Chief Executive Officer, Mike.
Thank you, Mr. Chairman. I don't have too much to report in this part of the agenda, or however, would just like to say, as the since the last meeting, as the COVID crisis and pandemic has continued to kind of shape the way that that we work, we have certainly, the organization has certainly risen to the challenge and done so in a time of significant market turbulence. I would commend all the members of our staff. They continue to amaze me with their ability to work from home and juggle all those responsibilities, as well as perform their duties for us in a basically uninterrupted fashion. I don't think we've, as far as the agency goes, I don't think we've missed a beat, and we've been able to continue to operate and to manage the assets of the trust in the best interest of our beneficiaries. So just wanted to take a moment to commend all of our staff for all their hard work, and just their ability to be able to manage these responsibilities, while a lot of them were also homeschooling and doing various and sundry other things. So we definitely have a staff of very good multitaskers. There's no doubt about it. So I'm pleased to have them. Again, as I said, they continue to amaze me with their adaptability in the way that we conduct business. So also wanted to give a short update, or a quick update on the budget. I think, as many of you know, certainly the economic fallout of the quarantine related to COVID and the basic shutdown of not only our state's economy, but economies all over the country as well as the world, is most likely going to have a significant impact on the state's finances, and their ability to meet has also been impacted by the COVID crisis and the desire to maintain social distancing and to quarantine and those types of things. So what the General Assembly did, instead of passing a budget this year, at this point, the General Assembly passed a continuing resolution. And basically what that does is it allows government to continue to operate past the July 1st, the beginning of the new fiscal year. And in essence, it carries forward the authorized amounts of appropriations into the new fiscal year, unless and until the General Assembly comes back and passes a new budget. We are not, or passes a full budget. We are not funded by general fund revenue. As just a reminder, we are authorized to expend trust fund revenue to operate. We also did not ask for any additional money. We basically asked for the same appropriated amount in the upcoming budget year as we did in the one that we still currently are in. So that has little to no impact to us as far as operating goes. One of the things that the General Assembly did do, however, was given that, you know, that we're carrying forward the same amount of authorization from last year. The General Assembly did freeze in place the employer contribution amount into the trust fund. So instead of that 1% increase that was scheduled, an additional 1% increase that was scheduled to go into effect July 1st, that will be put on hold by the continuing resolution. It's also my understanding that the General Assembly will likely incorporate that freeze for the remainder of the fiscal year into the budget. It is my understanding from, you know, talking to folks across the street that the intention is to, with the next fiscal year's budget, is to begin, you know, is to resume the escalating contribution increases until they're fully implemented. But in essence, there would be a 1-year pause on those. Obviously, you know, that does have an impact to the trust, but, you know, given the, you know, the budget constraints that state agencies are likely to face, you know, given the choice between, if they're given the choice between the increase or, you know, reducing staff, you know, I think the choice that they made is let's hold off on the increase and try. And I think that ultimately the General Assembly is really trying to gain an assessment of the significance of the impact to the budget. So they're scheduled to come back. Well, they're going to come back probably later this month. Maybe in the General Assembly come back later this month and appropriate appropriate the Federal CARES Act money. So they'll come back and do that. Then I believe they're talking about coming back in September once they get a more refined estimate of a more refined revenue estimate for the next fiscal year to look at doing a full budget. So which would remain in effect till the end of the fiscal year. But just wanted to give the commission an update on that. Certainly be more than happy to answer any questions.
Yeah, Mike, this is Ed. Could you just clarify the difference between our self-funding and the appropriations or the budget requests we make to the legislature and what we get and what the funds from the legislature are used for?
Ed, what we asked the General Assembly to do is to authorize us to expend trust funds to operate. And, you know, think of that authorization request at around about $15 million. And that would be split probably a little bit more heavily weighted towards, I don't have the exact breakdown in front of me. I can certainly get it to you. But think about that more, you know, probably about 55% salary, 45% operating. So, you know, like with most state agencies, the majority of our budget goes to personnel costs. So think not only salaries, but also our contribution to our folks' benefits as well. So our contribution to their retirement, if they're in the retirement system, the health plan, you know, those types of things. And then we also have our operating budget. So, you know, everything from our lease to our consultants, our outside costs, the various systems that we use, so it's those types of things that are in the operating budget. But I can get you an exact, I can resend the budget presentation to you, Ed, and it has a little bit finer breakdown for you.
I guess I just wanted to make sure I understood that the budget approval that we get from the legislature simply gives us that approval to expend what the amounts necessary to fund the operations of the commission, but we
Yes.
don't receive any direct financial assistance in that as a result of that budget. Is that correct?
That's correct. We receive no general fund revenue from, so in essence, an appropriation, not to get highly technical, Ed, but an appropriation is where the General Assembly appropriates amount of general fund revenue to a, for instance, to a state agency and allows it to expend up to that amount on a particular, for a particular purpose. Ours is an authorization where it simply authorizes us to expend trust fund dollars in order to operate.
Okay. Yep. I just wanted to make sure I understood.
Yes, sir.
Okay.
Yeah.
Thank you.
That's my, if there's no further questions, Mr. Chairman, that's my report.
Okay, any further questions for Mike at this point? All right, then our next item is the report of the Chief Investment Officer, Jeff.
Great. Thank you, Mr. Chairman. Good morning. In light of the turmoil in the first quarter, I thought it would make sense to spend a few minutes talking about some of the economic and market impacts that we're seeing. I'm also going to give you a brief update on steps that we've been taking to simplify the portfolio in alignment with the broader asset allocation simplification that was approved at the last meeting. And of course, I'm going to give you a deep review of the performance during the quarter. And by all accounts, it was a tough quarter.
Jeff, if you could.
Oh, yep, sorry.
One of the things that I wanted to make sure that we kind of set the tone and the stage for up front, because I think, because Jeff's going to talk about, how the quarter went. Obviously there was not only a significant impact to our portfolio, but, the portfolio of any investors who, like ourselves. And, the one thing that we've been striving to instill into our DNA, I think both at the commission level and at the agency level, is that we are long-term investors. So that as long-term investors, we should anticipate that we are going to have markets that behave this way, over the fullness of time. And so Jeff is going to talk about the impact of that specifically to our portfolio. But we're also, and you're also going to hear him talk about the changes that we are making to our portfolio to align it with the simple 5 asset class portfolio, or to align it more closely with that. I just want to make sure that we're clear from the beginning to not necessarily conflate those two things, in that when Jeff talks about the changes, that those changes are in some way a reaction to or reactive or to the short-term market environment that we've seen over the past couple of months. The changes that we're making and the changes that we're talking about simplifying the portfolio, Jeff and I and other members of the investment team have been talking about simplifying the portfolio for about a year and a half. Obviously, we spent a tremendous amount of time, working on the new SIOP, working on the new asset allocation to instill this simplified portfolio into our asset allocation. And, I think one of the things that we would see is that it certainly would have paid benefits during the current market turmoil. But again, this is when Jeff talks about the changes that we're making, these are changes that we're making in response to that very measured, thoughtful action that we took to adopt these changes, not a knee-jerk reaction to what just happened. So I just wanted to make sure that was clear, because we're also going to get we're going to hear from Makita a little later on, and they're going to talk about how investors should behave during a recession, and how assets behave and how investors should behave during a recession. We're also going to instill, the thought of having a long-term focus. So again, I just don't want us to feel like that we're saying that we're long-term investors. We just had a really bad market environment. Now we're making all these changes to the portfolio. Those changes to the portfolio this is just us making the change. When Jeff talks about it, these are just us making the changes to align the portfolio with that simple asset allocation, not in reaction to the current market environment.
Thank you, Mike. Certainly it would have been highly desirable to have the COVID-19 problem strike the markets right after we had made these changes, and we'd be having a very, very different performance discussion today. So the first quarter certainly presented many challenges, some economic, those flowed through very, very abruptly into markets. Certainly that affected our portfolio. We focused a great deal during the quarter on prioritizing our liquidity, which we discussed at the last meeting. And frankly, it even has affected the way that we work. But through all this, as I alluded to, we've remained very focused on managing the plan's liquidity position so that we don't become a forced seller of assets. And we've remained focused during this time on maintaining our exposures, rebalancing at the end of March to make sure that we participate as we expect to in the recovery that now appears to be underway. And in April, when we adopted a simpler policy portfolio, this will formally take effect in July. We're well on our way to implementing a number of changes that align with this, as Mike alluded to. But because of the market environment, we're going to be more methodical as it relates to certain exposures. Specifically, credit comes to mind, and we don't want to be in a position where we are selling bonds at depressed levels. So we'll be patient with that part of this transition, and I just want to make sure that we're clear about that. So let's take a look at what happened in some different areas of the economy, and this is going to feel like a mosaic with very small tiles. Did somebody say something?
No, it was just an echo.
Okay. All right. So whether we're looking at services PMI in the top left, GDP forecasts on the top right, industrial production, we've seen some very meaningful damage to the economy over in an extraordinarily short period of time. I just would like to point out this has happened much faster than it happens typically and organically at the end of a cycle. And in turn, what we've seen is this has flowed through inflation forecasts, which you can see the 10-year break even in the US, which tumbled meaningfully during the quarter alongside Treasury yields. This is, I put this early because this is something that can give us a little bit of hope. We are undoubtedly all aware of the massive surge in unemployment that we're seeing, even continuing this morning. But this chart shows us something that's interesting. The green line uses the scale on the left side. It's showing us that right now, at least, about 80% of the layoffs that have hit the labor market are expected to be temporary. But I think we all understand the longer the situation persists, the more likely, and unfortunately, these could become permanent job losses. Now, let's look at what jobs are being lost and who is most affected. And I'm going to tie this to South Carolina in just a second. So the industries that have been hardest hit so far are leisure and hospitality. That, I think, surprises nobody. healthcare, education services, professional services, retail, and manufacturing. And the chart on the bottom shows us that if you are a part of a lower earning household, you are much more likely to be affected in a way that has caused your household to lose employment income. So why is this important to us in particular? What I'm showing you here is, this is a little bit dated, but it lays it out pretty nicely. This is a list of the jobs in the state of South Carolina. And that list of industries that I just rattled off, more than a third of jobs in South Carolina are in those industries. And it's important to understand, I think, just because this is our ecosystem, how hard South Carolina is being hit and is exposed to what's going on. In response to the current labor situation, we're seeing something that can happen at times like this. We're seeing people exiting the labor force or failing to enter the labor force. It's hard to say whether this will remain the case, but it's certainly something worth paying attention to from a labor perspective. So let me shift to retail, and apologies, I'm trying to go expeditiously through this. Nearly every form of retail has seen just a massive decline from 1 month to the next. Notable exception, of course, stands to reason, online retailers and your Home Depot and Lowe's type stores have held up better, and they have not yet thanked me for that. It will be interesting to see if this trend, or if what we're seeing now becomes kind of a change in the way that consumers spend. But I think it's far too early to draw any conclusions there. Here's another busy page. This is what I'm trying to do is look at a couple of other consumption patterns. On the top left, we're looking at hotel occupancy, and the way this chart is structured is week by week. So the x-axis goes 1 to 52, and it looks at how is hotel rate occupancy trending week to week compared to normal. Normal is the blue line that is kind of the middle of the three lines that runs all the way left to right. What we've seen is hotel occupancy rates decline to about 25% before starting to show a rebound last month. On the top right, this is TSA airport traveler throughput, dropped by 96% from March 1st levels to late April levels. We have been seeing a bit of a bounce here. We're back to about 15% of normal. But this very clearly still presents a challenge. On the bottom left, this is looking at states that have begun reopening and is looking at restaurant attendance. And this is a dated chart. This is almost a month old, but you can see that states that have begun to reopen are really still struggling with seeing diners being gun shy about going out to eat. On the bottom right, this is a little different flavor of tracking the consumer. This is auto sales. Auto sales fell by 50%. I think of this as different because typically that only causes demand to be pent up. You don't usually make up for meals missed out. But if you have a car that you've put too many miles on, yes, you can put a few more miles on it, but pretty soon you're going to go buy a new car. So that creates some pent-up demand, as does, I would argue, housing starts, which have fallen materially as well. This is what we're looking at here is new housing starts, likely some pent-up demand forming here as well as mortgage rates have reached the lowest point in the now 49-year history of the Freddie Mac data set. Why do we think there's pent-up demand? Buyers are still looking online, renters are still continuing to pay rent, and purchase applications have begun to rise. In commercial real estate, this is in particular retail, which I think has been the hardest and continues to be the hardest space in commercial real estate. There's been a lot of stress, and in April, only 25% of mall tenants paid rent. If you own that mall, what are you going to do? Retail is extremely fragile, and you don't have, frankly, any tenants waiting to come in and take that space if you release these tenants that have not paid you rent. So that's a situation where there's no easy decision. Let me talk about energy for a minute. By mid-March, oil demand was declining materially, with most developed countries in lockdown. What you're looking at here is pollution patterns in France. March 2019 on the left, March 2020 on the right. So while we were consuming less, Saudi Arabia was offering very significant oil price discounts to customers in Europe, Asia, and the United States. These two forces came together in the US in the form of an extreme shortage of storage capacity. And because of the magnitude of the surplus combined with running out of space, we saw prices go negative in mid-April for the price of oil. People are being paid to take delivery of oil at the end of the contract. Let's shift to how are companies approaching managing the risk of the current environment. What we saw when the crisis hit was companies that had access to capital generally made two decisions to shore up their liquidity. One, they borrowed money, and two, they reduced their share buybacks for the time being. So how is all of this flowing through into markets? It's pretty simple. In Q1, the gap between safe investments and risky investments became as extreme as anything I've seen outside of the financial crisis over that short of a time period. Let me explain the table that you're looking at for just a moment. The first column, Q1, shows returns for various types of assets during the first quarter. The second column shows the return. I cut this off on May 26th. So you're seeing the Q2 returns through May 26th. The last column shows us what portion of the Q1 decline has been recovered at that point in Q2. So at the beginning of the year, the entire Treasury curve was below 2.4%, but by the end of the first quarter, Treasuries had earned over 8% during the quarter as yields collapsed nearly 100 basis points across the board. So other than investment grade bonds, we begin to talk about the degree to which everything performed more poorly than we expect over long term. Credit investments down 13 to 14%, equities down low 20s at the end of the quarter. Energy investments hit just by an extreme amount, 3 times in many cases. And as far as the recovery since the end of March, and this is some good news, we've seen a healthy recovery. Real assets have lagged in that recovery, with the exception of gold, which I would accept, which I would suggest that you think of not really as an asset class, but more along the lines of a currency, or perhaps even more appropriately as an anti-currency. So I just wanted to share with you some high-level economic observations pair that with some understanding of how the markets reacted to it in the first quarter. But now, even though we're not here to talk about Q2, I did want to make you aware of the magnitude of the recovery in some of these areas. But let me pause here and see if there are any comments or questions. All right. Let me move swiftly through our performance update before I get into our performance analysis. So here you can see during the quarter, the plan return was down 15%, making our fiscal year to date return down nearly 11%. We had some significant underperformance of the policy benchmark in the quarter, which I will talk about in the performance analysis. During the 9 months of the fiscal year, we have paid over $3.1 billion in benefits compared to $2.8 billion of deposits. The investment performance, as I just alluded to, is meaningfully negative in dollar terms, largely, entirely as a result of the 3 months ending March. This is the underlying detail of the performance analysis that I'll get to in just a moment. It is worth reflecting on something that this was overwhelmingly green 3 months ago, but the magnitude of the decline across many of these markets is just pulling down returns, not only short-term returns, but even some of the longer-term returns. One thing I want to flag for you for compliance purposes is that our aggregate private market exposure has, at the end of March, risen to be above the allowable range, which is 25%. We have arrived at the end of the quarter with 26% of private markets exposure. Pursuant to the SIOP, I am flagging this for you. This has likely already cured itself as markets have rebounded considerably since March, but this was something that we internally refer to as the denominator effect because of the negative performance at the plan level relative to the performance of the private markets asset classes. That is what has caused this, and candidly, that is what has already resolved it for us.
Hey, Jeff, this is Bill Hancock. Can we go back one slide?
Yes, sir.
How did our investments that are supposed to be uncorrelated to, let's say, global public equity, I'm trying to look through this slide, see how they fared versus what your opinion is on how they should have fared?
So, well, that's a very good question. It's something that I'll get to in a minute, but let me
Well, if you got it coming up, Jeff, don't let me interrupt you. Please continue.
Well, I mean, that's a good page to use to look at that. So I'll pull some of my comments forward here. So we typically think of core fixed income as being very diversifying, and it was up for the quarter. So it performed as you would expect. We were underweight to core fixed income, which is something that I'll hit on a couple times coming up. So a couple of things that I'll tell you were disappointing to me. Our GAA performance. Those strategies in aggregate were down roughly equivalent to equities, and that is not something that is certainly absolutely unexpected and candidly not acceptable.
I think you might want to give like a reason, because that's their exposures are in essence equities and bonds, so you wouldn't expect that.
They have a portfolio that has a mix of equities, fixed income, potentially even commodity exposure. And to have to wind up with the downside equivalent to roughly equivalent to equity is just not, it's not serving that purpose. So other things, credit is an area where we typically, I'm going to steal a comment that I'm going to give in a few minutes.
Jeff, can I maybe jump in just for a second? Just kind of my views on GTAA, since you sort of mentioned it, but I think I think this is a concept. I mean, you and I talked about it a little bit. One, I prefer keeping control, but back to the basic levers that a GTAA is pulling. In the big scheme of things, they're pulling, a stock bond lever, or historically a U.S. equity versus international type of lever, right? But I think it's really important as we think about rebalancing. So to a degree, in hiring a GTAA manager, one, we've outsourced that decision or that control, right? So, I mean, I think just fundamentally we have to say, do we want to keep that control, or are we happy giving away that control, right? The second part I would point out is between asset classes, just because of the way over long periods of time over which we're charged to look, right? If I take money out of equities and put it into fixed income over a long period of time, I'm trading a high returning asset class to a low returning asset class, right, on a relative basis. But for short periods of time, like we saw in March, that will, help, but that's a short-term effect, not a long-term effect, right? So in essence, there's an embedded incentive, if you will, for a GTAA manager to always be longer equities and underweight fixed income, because over a long period of time, that bet will pay, right? And that's quite a different level than, say, I'm rebalancing between U.S. equities and foreign equities, because any deviation there or any rebalancing between those theoretically over time doesn't deteriorate my return, right? Equities should have the same relative returns over long periods of time, right? Because just competition will, arb stuff out, right? So different groupings of equities will have similar returns over time, versus stocks versus bonds will not have similar returns over time. So I think in rebalancing and thinking about rebalancing and the types of rebalancing trades, I mean, we use it very generically, right? And then GTAAs, right, we sort of outsource the decision, but really giving thought to, that basic asset allocation versus what I call a strategy consideration within the asset class, much different levers. I've never liked it because I think you're outsourcing that control, and then it's not necessarily clear of what lever is being pulled, right? But I mean, at the same time, I mean, I'm not particularly surprised by this result, just because there's an embedded incentive to always be long, higher returning asset class to a lower returning asset class, right? Sort of just embedded in the business, right?
Yeah, that's fair. And yeah, Alan, to kind of build on what you said, we rebalance our portfolio really for exposure management, making sure we have the right exposures typically. And you're right, that's an outsourcing of part of that function for Alpha. Mm-hmm. So that's how I think that may be a helpful way to think about it.
Yeah.
So, Bill, back to your question, what has not performed as we typically see? And, for me, credit is another example of what I'll describe as unstable correlations. And we normally think of high yield as something that's going to kind of generically reflect a half equity, half treasury kind of exposure. In March, that was not half and half. That was more like 95% equity and 5% treasury. That's what the return kind of reflected. So you see that, and those episodes are usually temporary in nature. And for me, I view our responsibility as making sure that we understand what has happened and how that has changed the dynamic of the risk in the plan, but also making sure that we're not scared at a moment like that and selling an asset because it gave us a short-term bad outcome. And in fact, we added to some of our credit exposures during this in order to capitalize on some of that weakness. So, we're, not only are we not scared by it, we know it's going to happen at times, and we feel we know how to react to that. So, and we'll go into the bond portfolio much more deeply in a little bit. So, okay. Bill, is that helpful?
It is, Jeff, and I might be incorrect in this assumption here, but I would have always thought that the portable alpha piece of this, I thought that was kind of the piece that was kind of guarding our back door. In other words, when things were going really south everywhere else, this was the one that was supposed to kind of go the other way. Am I incorrect in thinking that way?
Yeah. So yeah, we don't view it exactly that way. What we have tried to build there is a portfolio that, to the extent we can avoid having market exposure, we're never going to have that be perfectly clean, but we get that down to what we think is about a 0.2 beta to equities, which is our principal risk. Most of the time even lower than that, but we know that there is some residual market exposure embedded in there, just in some of the structure of the trades that are in that portfolio. So we are trying to build that in a way that will have persistent positive returns. Now, I want you to think of that not as all the time, but very much over time. But when we talk about that internally, we want to see that portfolio be positive 4 out of 5 years.
Okay.
That's helpful. All right. So let me move through our 2 pages of disclaimers. Let me shift into the performance analysis here. I've mentioned this was certainly a challenging quarter for us across the board. If there's a silver lining, it is very much that the action that the commission voted to take in April, that simple portfolio that we've been discussing for quite a while, that portfolio outperformed the current policy portfolio by over 3% in the first quarter. And I think by the end of this discussion, you'll have a really good understanding of why. Let me talk for just a moment about what we've been working on during the past couple of months in service of the transition that we're trying to move aggressively toward. So we have been moving to indexing our public equity portfolio. We've further reduced the liquidity risk of our plan. We're working to further reduce the liquidity risk of our plan. This is underway right now by shifting our overlay exposure to be more core bond exposure, core bond treasury style, and less public equity, which creates some volatility that that causes us to need to plan for liquidity events. As it relates to simplifying the portfolio asset allocation, we've been reducing a number of what will become off benchmark exposures, but where we have suffered some mark-to-market losses, we are being very patient. I have no interest in selling assets at a level that gives somebody else a great forward return. And how does that affect us? What am I talking about when I say that? It's a lot of those credit exposures where we saw the returns be meaningfully negative in the first quarter. I'm being very thoughtful and patient about how we convert those to investment grade over time. I should point out that these changes that we're in the process of undertaking, my expectation, and I believe I'm being conservative here, is these are changes that will reduce the cost of the plan broadly by more than $40 million annually. I think that might actually approach 50 million, which over a 10-year period of time, that is considerable savings. The next several pages have a lot of detail in them, and I want to make sure that the message doesn't get lost in the detail. I want to be clear about what have been the biggest impacts during the quarter when we look at our plan's performance against the policy benchmark. We did underperform the policy benchmark during the quarter by a little more than 3%, which is means I need to make sure I'm being clear about why. First of all, our private equity and debt benchmarks are lagged by 3 months. What does that mean? It means that through the March quarter, our benchmarks don't yet know about the COVID-19 pandemic because they haven't gotten to it yet. Between now and June, they're going to pull down the total plan policy benchmark return together by about 2.4%. So I'm not going to despair right now about this, and nor will I be celebrating when we see this play out in our May and June returns. It's just the way the benchmark works, and we need to live with it. So we started the quarter underweight 4% to core bonds, which turned out to be the top performing asset class. So this was something that hurt our returns by 60 basis points. Our GAA managers, as I've already alluded to, and our portable alpha managers had a rough quarter, and on a combined basis, their performance pulled down our return by 130 basis points. In our other opportunistic portfolio, and I'm going to touch on this again in a few minutes, we had exposures exposure to master limited partnerships. Think of these as pipelines. This hurt returns. It was a small exposure, had a very profoundly negative month or quarter. That hurt returns by 40 basis points. But not everything was bad news. We had some really strong performance in our real assets portfolios and some really, strong outperformance. The nice thing about our equity option portfolio is it performed exactly the way we thought it would. And in a quarter where not everything did, that earns special notice. But our equity option and public equity implementation has been positive from a manager perspective. So let's turn to the performance framework. As a result of the markets being so weak, each of the benchmarks, as well as our total portfolio, have turned negative for most of the time period shown here. The value boxes in the middle show that the policy benchmark has outperformed the reference portfolio in all time periods that we're showing. The implementation benchmark, however, has lagged. We can see in the past year, there's been a very challenging environment for managers, and this bad 1 year is causing the trailing 3-year manager selection effect to be negative. This table is a version of what we've already seen, just designed to be simple and focus only on the quarter. This ranks the asset classes according to excess return during the quarter. We've seen a good amount of this underperformance in the bottom half reverse in our favor. since this time, but what I'm going to do is dig into these numbers to try to give you a better sense of what was happening. So let's start with portfolio structure. As a reminder, portfolio structure, what we're trying to tap into here is two decisions. One, the decision to be overweight or underweight an asset class, and two, the decision about how that asset class portfolio should be constructed from a top-down perspective. Going into the quarter, we had a small underweight to equity options due to very low premiums that we were seeing at the beginning of the quarter. Given the decline in equities, this has a positive attribution impact. On the other side of the equity coin, however, we were overweight other forms of public equity at the beginning of the year, and that had very much the opposite impact. I've mentioned the underweight to core fixed income. At the beginning of the quarter, we were underweight core by 4%. I alluded to this hurting returns by 60 basis points. Also, the negative impact from portable alpha reveals to us, and I'm going to slow down for this part because I think this helps remind everyone how this works. This negative impact shows us that the hedge fund benchmarks that we used were down materially in the quarter. On the next page, I'll show you, we did outperform those benchmarks to a modest extent. One final thing I want to make sure I flag here, I alluded to it earlier, other opportunistic. This is where we have the pipeline exposure. Even though there were only a small allocation, the crazy fluctuations in the price of oil wreaked havoc on this space. They were down very significantly, and the benefit, the good news is since the end of March, they've also recovered very significantly. So now we shift to the quality of manager selection. So we build from where the portfolio construction structure decisions left us. So now we're just looking at the incremental value of manager selection, which you can see is mixed. We had some real strong performance in our real asset portfolio I've alluded to. Equity options did exactly the way exactly what we expect them to do. We had some small hedges in the overlay, which helped serve as a bit of a buffer for our public equity portfolio. Our GAA portfolio, really disappointing. And we continued to see some disappointing performance from our legacy private debt portfolio. And here we can see the changes in exposures during the quarter. Our bonds portfolio, we show declining by 3%. This is actually a reduction in the cash position, which we deployed in order to maintain our exposures to key risk factors, most notably public equity, when we rebalanced at the end of February and March. We did remain underweight to core fixed income even past the end of the quarter. And we did capitalize on some of the turmoil in the credit markets at the end of the quarter by adding exposure there. That is going to be helping forward returns. In our equity portfolio, we continued to rebalance, as I said. We maintained our exposures. I mentioned we started the quarter underweight equity options due to the low premiums. During the quarter, premiums not only reached more normal levels, but became really attractive, and we added this exposure back. We began to shift to passive management across our public equity portfolio during the quarter, as I've alluded to, and that transition will be complete by July 1st. And I want to give you a sense of how sharply our risk statistics have changed. what we're looking at here is our estimate of volatility of our portfolio over a trailing 2-year time frame. It is equal weighted. There is no decay, and that means that volatility experienced last week receives the same weight as volatility experienced a week 12 months ago or 23 months ago. 3 months ago, on the top of this page, all three of these volatility estimates were between 8 and 8.5%. So with one volatile quarter, and frankly, it was really constrained to the last 7 weeks of the quarter, these numbers have jumped considerably. And I think it's important to reflect on that. And Bill, this is where I tie this back to your question about how do assets behave. In extreme market environments like what we just saw, we often see two things. One, obviously a generic spike in the volatility of risky assets generally. But the second thing that you'll often see is what we think of as the normal correlations among risky assets. Those correlations become very unstable. And when you hear people talk about correlations going to 1, that's what they mean. And the example I gave you is high yield and even emerging market debt behaving much more like equity during the downturn than they do during normal times. You know, typically high yields 50-50 treasuries and equity roughly. And in March, it looked like 95% equity and 5% treasuries. So when this is happening, it's my very strong belief that we have to remain disciplined. We have to continue to focus on the long term. And what is happening in the short term is simply an opportunity for us to acquire assets that have been beaten up. And we were able to do some of this during the quarter. And I'm confident that the returns on a go-forward basis will benefit. We did not do as much of it as perhaps I would have liked in a normal, quote unquote, normal recession. But the circumstances around what is causing this recession, I just don't feel that I have any unique ability to forecast the patterns of a virus. So this was more marginal than it was a couple of years ago when we took action. And we do continue to prioritize our liquidity. We are in an even stronger liquidity position today than we were at the end of March. And if there is you hear people talk about a second wave, if there is a second wave, if there is weakness, we will be in an even stronger position from which to exploit that. So, Mr. Chairman, I apologize. It took a good long time, but this concludes my performance remarks. I'm happy to answer any questions or, react in any way to any question or comment that anyone has.
Jeff, this is Ron.
Yes, sir.
On that risk estimates, there where you're saying policy, is this the current policy or the simplified?
This is the current policy, and I have the simplified. I'd be happy to dig that up if you'd like. It may take me a couple minutes to find that.
No, that's okay. I
can follow up with you offline if that's.
Sure, that's fine. That's fine.
Just what, Ed, this is Ed. As far as your liquidity positions are concerned, are you using cash or a combination of cash and treasuries, or what do you basically, how do you feel about what you should be, what assets you should be using for liquidity?
Short term, high quality.
Yes.
It will include treasuries, agencies, even some high grade commercial paper, things like that. Think about the types of assets, Ed, that you'd see in a money market fund. There's gonna be a lot of that. We do at the margin have a little bit of short duration high yield. We've had it for years. That is not something that we typically include in our when we talk about our liquidity position. We omit that because one thing, you know, I don't have all the experience, but I have enough experience to know that when you really need to tap into your short duration high yield, you're not going to want to sell it at the prices that would trade at. So that's just sort of that's one of the last things that would get removed in an emergency. We have other ways of accessing capital that would be less painful than that, but that's there for a little bit of a yield boost. It's a small allocation.
Okay, are there further questions or comments about the investment performance update just presented?
Okay. If not, Mr. Chairman, I have one more slide that I have as a part of my remarks. Oop, I went too far. I want to give an update on the status of some of our priorities. As of the end of March, I'll be candid, we had some other things competing for our attention during the first quarter, but we were still able to move a number of these projects forward. And apologies, I wear bifocals now. We are nearing completion on the reporting framework. We are still exploring ways to improve that, so we are not declaring that complete. Our co-investment platform, we are seeing a lot of opportunities to broaden that beyond private equity, and we're kind of working on the framework to guide the risk of doing that. But we are completed and off and running, and it is just working very well. What the commission agreed to have us do in private equity, and I can't wait for those returns to start coming through. The other area where we've been focused is on adapting our process in order to allow us to better leverage the specialty consultant as more of an extension of staff model. You know, we have great staff and we think they do a lot of really good work, but what our specialty consultant is able to bring to us is a staff of 100 more people that are contemplating an array of investments. And we've been spending time thinking about how we can restructure our approach to not have to create redundant workflow with what they do, but rather build on what they've done. And if we think that there are things that maybe we need to get comfortable that they've flagged, we'll spend our time on that. If we think that perhaps there was a gap in their work, as an example, our value creation work that we do, then we would fill in those gaps and then have kind of a hybrid report that has builds on what the consultant produces, and we sort of have our report on top of that. So we've been doing a lot on that, just trying to figure out how to have some force multiplication so that we can cover a greater array of strategies, and which we think is a really important factor and a change to our approach that will help us improve returns over time. So let me pause there, and I'm happy to answer any questions about anything thus far.
Further questions for Jeff at this point? Okay, Jeff, are you going to talk about the AIP progress as well?
That was the slide I jumped around pretty fast. That was that slide.
Okay.
I just pulled up, so that one is checked off.
Okay, thank you. Thank you. Now we're at a point where I could choose to take a break at this point before Makita begins its presentation, or continue, since we're all working with the ability to stand up, move around, and so forth. I'm sort of inclined to continue, but I'll be happy to call a 10-minute break if commissioners think that's preferable, or Mike, if you think that's preferable.
I'm fine either way, Mr. Chairman.
Any of the commissioners suggest we have a break at this time?
Either way for me.
I just soon keep going.
Okay, then let's proceed. Jeff, will you introduce the next report?
Mr. Chairman, I'll go ahead and do that. We're gonna turn it over to Makita, and for as we know in our strategic calendar, we've designated hearing a strategic investment topic at every commission meeting, and in this instance we have two that Makita is going to address. The first being, and I alluded to this earlier in the meeting, they're going to give us a presentation on long-term investing in a recession. This seemed like it would be a very timely topic for us to consider and to think about and to receive their perspective on, especially given, again, our really thought process of trying to instill within our collective DNA a long-term focus, and that I think that it's very easy to try to become detached from that long-term focus and in a recession, and when we've experienced the market turmoil that we've had over the past quarter. Also, want to begin in the next topic would be in regards to China accounting and auditing rules and standards. This will be, we're going to get a short presentation from Makita on some legislation that is moving through Congress right now in regards to Chinese companies that are listed on U.S. exchanges that don't necessarily follow our accounting rules or will not subject themselves to review. And this is I believe it's a timely topic to begin a discussion on, because we are seeing legislation on this at the federal level. I would anticipate that we will also see some legislation even in our General Assembly regarding investing in China. So I think beginning this conversation, trying to get an idea of what the controversy is about in regards to these Chinese companies and their accounting standards, I think is a good conversation for us to begin. And then I think we'll be looking for some guidance from the commission as to how we should think about this issue and potentially framing it for further discussion at subsequent meetings. So, Allie, I'll turn it over to you.
Great. Thanks. Good morning, everybody. As I think we all got a chance to meet virtually at the last meeting, but I'm Allie Wallace-Stone. I'm joined by my colleagues, Leroy Brantley and our co-CEO, Peter Woolley. So they're both on the line as well. And Leroy's going to kick off the beginning of the long-term investing in a recession presentation. So I'll turn it over to him, and then I'll jump in halfway through to complete the presentation. So thank you for the time. Leroy, are you there?
Hello?
Leroy, are you on?
I hear somebody typing. Maybe you're emailing him.
Can you hear me?
I can now, yep.
Okay, so apparently my phone's not working, but that's great. If we could, thank you, Ellie, for the introduction. If we could turn to page 2, that would be super. Or should I try to share my screen? I see our presentation up on the screen, but
Roy, I'll drive for you.
Oh, thank you, Mike. Okay, great. We put together an executive summary here, and the purpose of the materials here is to walk you through the typical events that accompany a recession. And during the course of this presentation, we'll walk you through what the exact definition of a recession is. We're not in one right now, but we foresee one over the horizon, and we'll give you some examples of that. The main takeaway of this presentation here is for investors to understand the importance of maintaining the view and keeping the behaviors of a long-term investor, and that's what we are here. And we'll examine some events like what we're going through today through some of our stress testing that we give you examples of in the presentation. But one of the key takeaways that we want from this presentation, and as Mike mentioned, it's a timely presentation, is to remain calm, because during periods of market turbulence like what we're having now, there will be some damage done, especially to the equity side of the portfolio. But the flip side of that is some great opportunities occur due to the dislocations in the market. And as Jeff talked about earlier, it's very important for us to be buyers in those situations. So that really stresses the importance of liquidity, but more importantly, stresses the importance of calmness. And right now, we're experiencing the effects of a global healthcare crisis. We're going through a pandemic, suffering some of the largest global equity losses in 10 plus years, going back to the global financial crisis. But we want to provide you with some framework, once again, for how to navigate times like these. So if we flip over to page 3, we go through the definition of a recession. And we have 11 recessions illustrated here going back to World War II. And the most key is the significant drop in economic activity, which we've seen so far. One of the things that we haven't had happen is the tenure, the length. This is really, several months into the market correction, so it's not long enough to typically be a recession, but we've seen hits to the GDP, and we've seen unemployment go from 4 to 5% to well within double digits. So we're seeing all of the early signs of that. And companies' top lines have been hit. And we've seen some companies reduce their workforce to shuttering. So there's some severe impact on unemployment, if you will. We've seen a drop in spending that's happened. Not so much a savings increase, but more along the lines of a worry about savings. And last item there, we have seen a drop in equity and corporate bonds happen. But once again, we have not had enough time. If you go back to the global financial crisis, that was 8 quarters long. It was part of 2007, all of 2008, 2 quarters into 2009. We flip over to page 4. If we flip over to page 4, can you hear me? here. A little bit different from recessions. This page focuses in on bear markets, which usually precede a recession. We have 16 occurrences here going back to the Great Depression. As you notice, the Great Depression took over 22 years to recover from that after dropping 85%. And if you go to the bottom of the page, you can really see that impact on time, average time, with the with the Great Depression skewed out. That average goes down by more than 2 years. But keep in mind, bear markets last on average about 2 years, but they seem much longer at the time when we're going through them. The key piece to remember here is each time we've gone through a bear market, which is a drop in 20%, the rebound has been much greater. We've recovered more than 100%. In fact, if we go and look back at the global financial crisis, we had 10 years of global equity prosperity that occurred with very little volatility in the markets. And we were talking about some of the asset classes that are lowly correlated to equities. That made us question having some of those programs running, especially hedge funds took on a lot of consternation during that time. But the important thing to remember here is each time we've gone through this, the rebound occurred, and the importance is to remain calm. And these were some very, I just mentioned very little volatility. March, the volatility was such, and we'll talk about this later, where you not only had a bear market happen where there's more than a 20% correction, you had a bull market occur also. And you saw patients paying off during a month like April, during that bounce back, if you didn't panic and sell out of your risk assets and move over to some of the risk mitigating assets. But it's important to see here with these last two occurrences, you had 56 months to recovery and 49 months to recovery. But if you look up at the other two prior, there's 4 months and 3 months. So we're hoping for more of an occurrence like the previous two, as opposed to the most recent two here. Page 5. Here we give you 6 occurrences of market distress. One main observation, and Jeff talked on this during his presentation, is the emphasis on the importance of diversification. If running markets can really build up some complacency and performance chasing, and it can really diminish the thoughts about risk mitigation. As you look over all of these occurrences, the top 4 lines there with cash, investment grade bonds, long-term government bonds, and TIPS, you see that the cash and the rate sensitive risk mitigating asset classes held up very well. In fact, in some of these cases, most of these cases made money. So it's very important to remember the roles of the asset classes in these programs, particularly when the markets are roaring, to keep an eye on correlations going to 1, as Jeff mentioned, and that being a negative thing. It's nice to have these particular asset classes that you can go to source spending and to preserve capital in the portfolio. And as you will look at these last 2 episodes with the GFC and the tech bubble, you'll see that equities lost more than 40%, and investment grade bonds over these last 2 periods gained almost 10% and 30%. So it's very important to not just look at hedge funds and other risk mitigating strategies to help you here, but it's very important to understand the importance of bonds in a portfolio and what they do for you in terms of diversification. With this being said, I have full recognition with the current rate and yield situation. Investing in bonds has been a very sort of precarious undertaking with those elements in mind.
Leroy, can I ask you a question about that real quickly? Just because I do think this is a pretty material, conversation.
Absolutely.
And some of this even gets to kind of a market structural question, but in a world of, for lack of a term, sort of government rates, which are negative in various places, and then corporate rates, which has actually gone up, not down, because they're tied to the same cash flows, but then to a degree, you have a certain amount of central bank support activity. You're really kind of into a world of relative currency bets, right? Like even the corporate kind of goes back to the sovereign, and the sovereign kind of being negative and various sovereigns being sort of negative, right? Does that change? And I ask this as a structural question because I've seen this both kind of what happened in Europe, for lack of a term. In the old days, you had various bond markets, and say CTAs took advantage when rates would shoot up. So when Greece blew out or Spain blew out, right? In the old days, the returns associated with that would have been captured in a futures market by a CTA kind of trend following strategy. Then it sort of moved into a CDS type of trade, which credit managers may or may not have availed themselves of. And now we're kind of left with relative currency bets, right? Kind of, the currency plays a greater and greater move than what the interest rate component is, right? And so I asked that of how does that change our thinking in the type of managers and the role of fixed income? Because it's essentially a speculative currency bet now. It's not an investment class anymore, right? It's a speculative trading class, for lack of a better term. How does that change our thinking? I know pensions tend to be slow, but I mean that's the reality of where we find ourselves. And how would that change manager selection or product selection and things like that?
Well, on top of what we've seen in terms of an unprecedented run on equities, and you brought up a good point with the sort of intervention, the quantitative easing that we've seen here, that's really been a prop for equity markets doing so well. But the flip side of that is that U.S. equity markets have also been perceived as more of a haven than the international ones, both developed and emerging. And a part of that problem has been the currency on the equity side as well. So you really do want to keep equity as a diversifier. Currency as a diversifier on the equity side. So I tend to recommend managers that don't hedge the currency away, keep that as a diversifying component. Mostly because equity managers have proven themselves to not be very skilled at hedging equity. The flip side of that, when you look at the fixed income and the debt side, it has been a huge currency play. In fact, if you look at most of the global fixed income managers, particularly those that delve into opportunistic, doing some credit and doing some high yield and emerging markets on that side, a key point of outperformance or underperformance has been the currency piece. And the fact that the US dollar has been so strong for so long, I would have to say that's an unprecedented streak of strength. And in fact, when you look at these managers, sometimes they're underperforming, even on the equity side. If you were to look at their portfolio in local terms, it has not been that much different from what we're getting here. But the equity piece, the currency piece has been a strong sort of headwind, and managers where that's impacted them really hard, it really shows up in the results. So when you're picking these global fixed income managers, they have to show that they have a real acumen for navigating both the bond purchases in these countries and also the currency pieces. So I would say manager selection will weigh heavily in terms of diversifying your bond portfolio to include global managers in addition to the domestic ones. Does that answer your question, Alan?
It did.
Okay. Perfect. So if we can flip over to page 6. And what this gives you is, it illustrates the worst case outcomes for 4 different portfolios. And what we mean by worst case is you're looking at a sort of 3 standard deviation occurrence here. And what that means is these elements have a 1% chance of happening. What we've done here, do the dogs approve? What we've done here in these sample portfolios is starting with the current one, which has 18 assets in it. And we've gone down from overly complex to overly simple, ending with US equity. So the movement is sort of 18, 5 assets to equity fixed income mix here. And what you see in the outcome here is that the 5 asset mix is sort of like the Goldilocks mix. It's just right in terms of demonstrating the best protection of capital and demonstrating events where money's being made, that the highest return is being generated here. But when we go through analytics like this, I want to give you a caveat, is that A, the assumptions can be endpoint sensitive, meaning we're coming off of a period where we've had a 10-year run-up, unprecedented in that sense. And B, the left tail results can be understated. For example, we point out that the system declined by 29% during the GFC, and in none of these boxes you see any of these programs going down anywhere near that. But keep in mind that this model does have a long-term mindset with volatility built into it. But this is just to give you an idea of, we think the move to the 5 asset mix is the right move. It simplifies things where we could be more effective in terms of portfolio construction. Page 7 gives you a glimpse. Mike? There we go. Thank you, Mike. Not going to go to through the details here of recent performance because Jeff just did an excellent job in walking through the details here. But what we will say is that COVID-19 has had, a greatly negative impact on the markets. But once again, April was that really nice bounce back that we saw by being patient. And in this group, and we give you the performance and we give you some benchmark references, but we'll end here and say we think all of the indicators that have been at work in the market during this correction point to the fact that we may in fact see a recession occur for this quarter and the third quarter in terms of the indicators that I highlighted earlier in the presentation. So if anyone has any other questions, I'm more than happy to answer them, but Ali will continue on with how to navigate through these times and mistakes that some investors make through not being calm and looking to ferret out opportunities as opposed to selling assets that are declining in price for liquidity or for a feeling of security, if you will.
Leroy, or before you hand it off to Ali, let me jump in real quick. One of the things that I want to make sure that we're being as transparent as possible, and given that we have these numbers up here, that when this performance deck was put together, these were our, as far as our April returns go, that was our best estimate using a lot of public proxies, I think, at the time. We received our official numbers on April yesterday. So our April return is about 2% actually less than what we estimated it was. So although, still a good month, but think of that more like 5.2%, and our fiscal year to date number is more like down 6%. So, we're through April. Yeah, through April, we're still looking at obviously, markets continue to rally in May. We believe that we'll benefit significantly from that again. But I just want to make sure that we're, when I don't want for the commission to see this and then in a couple of days see our official numbers and wonder, what happened. So, but we're still pouring through the detail. Sometimes there's, discrepancies, but I just want to make sure that we were being upfront.
Thanks, Mike. So with that, unless there are questions for Leroy or Mike, I'm going to jump into the second section here, which starts off with mistakes made by peers in the industry on page 9. And so we've highlighted 4 key mistakes that are oftentimes prevalent in this type of environment and prevent long-term investors from achieving their targets. The first and foremost, it's becoming risk averse in these markets. So obviously, people establish their long-term risk appetite and in conjunction with that, establish their long-term asset allocation. However, during these difficult times and periods of market distress, and significant volatility, oftentimes people get nervous and become more conservative in their strategic asset allocation. We've seen that in the past from many institutional investors, and it ultimately is preventative in benefiting from the market rebound that Leroy discussed is typically larger than the downturn experienced, and is ultimately preventative in achieving the long-term return. As Leroy mentioned, when we're designing asset allocation, we acknowledge that there'll be times and periods of market distress. So you just need to ride through those times and maintain your level of conviction in your asset allocation design. The second key mistake we see a lot of people making in these types of environments is deferring commitments to private equity. So as you know, you have a pacing study and a design in terms of your private markets allocations. And in order to maintain that overall allocation, you need to periodically commit capital on an annual basis. And oftentimes when you get to times like this, periods of market distress, people get concerned about liquidity profiles and get concerned about allocating further assets to what's perceived a relatively riskier segment of your overall portfolio. So they defer allocating more. And typically this is kind of at the worst time to defer allocating, because as you know, when you allocate to private markets, you're committing over a subsequent investment period of 2 to 3 years. So typically once those assets are deployed, they're getting deployed at lower valuations because it's after we've experienced this market downturn. So it really is to the detriment of investors to deviate from your plan from that perspective and not deploy assets to maintain your strategic alignment with your overall private markets target. Third of all, kind of on the flip side of this, is over allocating to illiquid assets. So one of the things that you need to be prudent of consistently, regardless of the market environment, is evaluating your overall asset allocation to ensure that you're not taking on too much illiquidity risk. And I know that's something that you guys have done regularly as part of your asset allocation study with Frank and your staff. But evaluating scenario analysis and stress testing your plan to ensure that in periods of market distress, you can still pay out beneficiaries regardless of having capital tied up in private markets, and you're not a forced seller in the secondary market in times of market distress.
Allie,
yes.
Allie, can I jump in real quick on that? One of the things that I wanted to make sure that the commission was aware of, and I think we spent a significant amount of time, talking today about, over the past quarter, the things that didn't work. But one of the things that, I wanted to take a moment to recognize, and I think that this hit squarely to your point, is that that Jeff and the team did a fantastic job of, as we moved into and through the throes of the market turmoil, ensuring that we did have sufficient liquidity. So although we have felt we have felt the pain of the impact of the market turmoil on our portfolio, we have not found ourselves to be forced sellers of anything, which, as long-term investors, that gives us the ability for those assets to recover those values that were lost during the market turmoil. And this is something that we had been planning for. We were, Jeff had done some tabletop exercises with the team to make sure that we were ready for this type of event. And that once we saw what was coming, immediately took action to ensure that we had sufficient liquidity. So, although obviously the impact of the portfolio is something that we spent a lot of time on, I did want to take a moment to indicate how proud I am of the staff for what they've done to ensure that we were able to meet those benefit payments without having to crystallize any losses that or to be forced sellers of things that we didn't want to sell anyway. So thanks, Allie.
Great, thanks, Mike. Yeah, that's great, and it's clearly indicative of well-planned investment design, and that's what we're trying to always be cognizant of, regardless of the market environment. So using liquidity stress tests and evaluating your liquidity profile on a regular basis obviously proves fruitful in times like these. And then the fourth mistake that we see very prevalent amongst your peers in the industry is seeking to market time. So oftentimes people think they've identified the bottom and they'll rebalance, right to the top of the equity target in anticipation of an equity market run up or something like that. We think prudent rebalancing is crucial and essential to your long-term success, but seeking to market time and identify the bottom by taking large bets at any one time often is unrewarded, and even the best investors that are being paid, multi-million dollars per year are typically unable to achieve this. And so we want to avoid just kind of trying to pinpoint any significant fluctuations in the market. So the next page 10, just kind of piggybacks off some of those lessons learned and then goes into what institutional investors should do in this environment. And first and foremost, it's crucial to rebalance your portfolio. Periodically rebalancing back to your equity targets will ultimately maintain your same risk profile and allow you to have the highest probability of achieving your long-term return expectation. We've displayed this in the chart that you'll see on page 10. And here you see that the investor that stays the course, as indicated by that orange line at the top, is the investor that is the most rewarded in this environment. So the investor here that stays the course is one who rebalances monthly to their targets, which is very similar to what Jeff and your staff have done for you guys in terms of rebalancing back to your equity targets in times of market distress. The investor that is the most pained by this environment is the one that gets more conservative. And this is indicative of an investor who became more conservative 2/3 of the way through the global financial crisis and the implications that had on their overall fund. And then right in the middle of that is an investor who never rebalances. So ultimately their asset allocation is deviating as a byproduct of a distressed equity market and a run up in bonds, giving you a more conservative allocation, but maybe not as drastically so as the blue line indicates. So while these deviations look really minor on $100 initially invested, as displayed in the chart, you can see at the total level, they're significant. So on a plan of over $30 billion or on a $30 billion fund, that differential equates to $2.4 billion difference. So rebalancing is going to be key to maintaining long-term success and allowing you the highest probability of achieving your assumed rate of return.
Allie, this is Ron. One question about the frequency of rebalancing. You mentioned 1 month. Is that typical, and what Makita recommends for that?
Yeah, so it's a good question. Thank you. So we've done a lot of analysis on rebalancing. Ultimately, it seems like between monthly, quarterly, and semi-annually, there's not a huge difference in the overall success level of a plan. Some benefit over short-term periods from monthly rebalancing, some benefit from less frequent rebalancing. The one thing really cognizant of is transaction costs. And I know your staff really evaluates those as they liquidate and reallocate appropriately within the rebalancing profile, but just being aware of not incurring overly high transaction costs as a byproduct of too frequent rebalancing. But evidence has shown historically that rebalancing is key and the frequency is less impactful on overall plan performance. So we think monthly or quarterly is prudent.
Can I maybe, I think this is an important question, and so can we spend a little bit more time on this, just because, Jeff, I know you and I have talked about this a lot, but I don't know if we've ever really, I don't want to say sort of codified it conceptually in our documentation or not. I know you're kind of aware of this, but this is sort of what I was alluding to earlier, right? I mean, rebalancing, there are different types of rebalancing between asset classes and within asset classes, and they're done for different reasons, right? So one reason is for just kind of risk or policy reasons, and the other is for trying to make money reasons, right? So at the, and this gets to the frequency question, right? To the extent that I'm rebalancing from high returning asset classes to low returning asset classes, realistically, because of compounding, I should do that relatively, infrequently, right? And only when there's large deviations, right? Because I'm essentially selling off a high returning asset for a low returning asset. So short of a policy reason, that's something I want to pull that trigger very infrequently, and probably more in response to either risk policy or just large deviations like the one we had in March, right? But that should be a relatively infrequently pulled lever, right? Rebalancing within asset classes should probably be a more frequent type of things, because most time those differences are going to be arbed out relatively quickly, right? So I think we use the term rebalancing, but I think it's really important. Yeah, and I think you bring up some good points, Allie, about the frequency, but then the type, right? And then the reason for it, right? We should know the reason we're rebalancing. We should know the type of rebalancing we're doing, and then we should know the frequency over which we're sort of measuring, those things. But I just think that having a real systematic sort of approach to that's important. But like, I'll give you an example, just a kind of real time, because this came up, right? In March, government bonds went shooting up, right? And corporate bonds sold off with equities because they were tied to the same cash flows, right? So within our fixed income asset classes, in my firm, right, we sold government bonds and we bought corporate bonds as those spreads widened. At the same time, we were rebalancing into equities because we had a large deviation, relative to bonds generally, but not as much between my corporate bonds and my corporate equities, right, which were tied to the same cash flows. But I just think rebalancing policy should understand the different types and reasons that you're rebalancing, right? And then we size that in part because volatilities were higher, right? So I was already sort of above my risk assumptions for a portfolio, right? So I had to size it appropriately, right? So my policy might have been 60-40. I'm low, but my volatility's, 2 times my base assumption. So I moved towards my goal, but I didn't go to my goal, right? Because my risk factors were higher. I mean, I think that's how we make these risk return and correlation assumptions and policy decisions real day to day.
Yeah, I'll also add that the mic being heard. Can you hear me?
Yeah, there's a little bit of reverb going on.
Okay, I canceled my phone. Yeah, one of the most important pieces here is the discipline, and those are excellent comments on why and the mechanics behind it. But one of the most important reasons for having these sort of guidelines and having that level ranges is to force action in certain situations where you can get asset classes that totally outrun the others. And it's most important in those situations to rebalance, to do it yourself before the market does it and before you lose that purchasing power. So all of these elements come into the importance of this discipline from a risk control standpoint, but also from a maintenance of purchasing power standpoint as well.
Yeah. So I guess my question for Makita as a board member, and less so about Jeff, is how codified should rebalancing policy, how common is it to have more detailed sort of rebalancing policies, right, from a board level, right? And so one, how common is it? And then B, should there be more codified rebalancing policies?
I think South Carolina is the most disciplined and most detailed oriented. And when you can use rebalancing to bring down asset classes that are, as I just said, outrunning others, and you can use that sort of excess to pay out benefits and things of that nature. There are other pieces like benefit payouts, and then you're going to have to pay capital commitments for your private investing. All of these elements could call for you to bring down those others, but in terms of detail and discipline, I'd say South Carolina is one of the most in both categories that I've seen across plans.
And one of the things I've seen kind of across some large plans that try to kind of overly define the rebalancing policy is then you get into instances like we experienced in March where there's a lack of liquidity in the bond market, but you're forced to incur significant losses just by selling at an inopportune time. So I think, while you want to have a rebalancing policy that indicates kind of process-oriented approach, I think there is definitely a need for a little bit of prudent latitude to ensure that you're not just being a forced seller because you hit different thresholds or different points.
Hey, Alan.
Yeah.
This is Jeff. Maybe if you're open to it, why don't you and I connect sometime in the next couple weeks, and I can give you a little more visibility into what we're doing, and I'd like to hear a little more, frankly, from you on it too. So
okay.
Maybe that's a way for us to kind of move it forward a little bit.
Yeah, that'd be good.
All right.
I'm happy to share examples of things that we're seeing other clients do as it pertains to their rebalancing policy. I just worked with another large state plan to kind of revamp their rebalancing policy, and as part of that, we shared with them a number of samples. So if that's helpful, I'm happy to pass that along as well.
Yeah, I'd love to see that.
Okay. Perfect.
All right.
So if there aren't any further questions on the rebalancing section, I'll turn to page 11, where we acknowledge the benefit of potentially exploring opportunistic investments. And I know this is something that your staff has evaluated closely in this environment, and obviously opportunistic investments differs based on the environment that you're in and the crisis that you're experiencing. But one example of this is in 2008, you can see credit spreads blew out in high yield quite significantly. And that was pretty indicative of the fact that you were going to experience a positive return from credit spreads or from high yield bonds going forward. They were really cheap. We acknowledged the benefits of high yield bonds over the long term. And as a result, that was an opportunity that we had conveyed to our clients and that our clients leveraged to some extent to benefit from a subsequent rebound over a year's period of a gain of 49% in the high yield bond market. Today, there are other opportunities to explore. I know your staff's explored some of the benefits of the TALF program, as well as some of the benefits of different credit investments. And so in every distressed market, there's opportunities that present themselves as a result. And I think it's important to explore those and explore the risk and return profile of them and deploy assets there to the extent that you feel like the return benefit outweighs the potential risk. The third item that we think is crucial is stay the course. And this just kind of goes back to rebalancing and avoiding the potential behavioral bias associated with getting fearful during periods of market declines. So again, avoiding getting more conservative at this point in the market and maintaining a discipline to your strategic asset allocation. You see oftentimes investors fall victim to environments like the one we're experiencing most recently, where they do get more conservative, or they, seek to return chase in periods like we'd experienced previously with equity markets on a run for 10 plus years, and maybe allocate overly to equities in hopes of participating in that run up at an inopportune time. So if you look at the Morningstar publishes an interesting article on an annual basis, which displays the gap by asset class between an investor's return and the actual return derived by that asset class. And this one's a little dated. It's 2012, because realistically, this gap has shrunk through the end of 2019, as you would expect, when pretty much all asset classes were relatively beneficial, particularly equities. But I anticipate that next year you'll see a blowout in that gap again, more similar to what you're seeing in this 2012 chart, where an average investor earns 6.88% by allocating to US equities, whereas the total return of the asset class over that time period was 7.89%. So you can see just by the behavioral biases and the potential risk aversion and investors seeking to time the market, they missed out on 1% of return there. More significantly, it's displayed at the international level with a gap of 3% between what an investor actually derived and the return of the asset derived. Municipal bonds are also, significantly gap. And oh, sorry, I'm getting a little bit of a echo, but and then all funds overall, just when you look at balanced portfolio and across the asset class spectrum, on average lost about 1% of an investor's return relative to the total return of those combined asset classes. So it just further indicates that it's really hard to time the market, that there are significant behavioral biases that are typically prevalent, more so in these types of distressed market environments. We just need to be cognizant of that and avoid falling victim to them by trying to market time or shift our strategic asset allocation during times of market stress. So page 13 then highlights forward-looking. Obviously, it's really hard to determine what the long-term implications of the pandemic, the US economic stimulus, and the resulting impact that's all going to have on the global economy and the capital markets. But our team is reviewing it all closely, and we're evaluating what kind of potentially secular impacts this could have on lower interest rates, on inflation, on the long-term implications this could have as a result of lower energy prices, the potential retreat from globalization that we could experience as a result of the pandemic and some of the geopolitical concerns going on globally. And then the long-term changes in the real estate markets. That's been something that's kind of been at the forefront of our research team's mind, as well as just kind of across the industry, is how different sectors of the real estate market, and most importantly, how is the core real estate market going to hold up going forward as a result of this kind of new normal that we're in? Are office tenants going to be as additive to your core real estate portfolio as they have been historically? Debatably so, I guess, in light of the fact that we're all successfully holding this meeting and many others from home. So we're just kind of evaluating what these long-term implications are going to look like and how they kind of reverberate through to your asset allocation design, and whether or not it shifts some of our model portfolio and asset allocation expectations going forward. And to the extent that we do come up with some things that we have concerns with, or that we think are significant changes in the new normal as a result of this environment, we will convey that to you guys over the next 12 months and continuously so. But these are the 4 topics we're really digging into over the next 12 months, and refer back as we address asset allocation and portfolio design. So kind of in closing, as we look at long-term investing in a market recession, I think you just want to acknowledge that recessions are going to inevitably occur, and we're likely going to experience a recession currently as a result of 2 quarters or more of declining GDP growth. They can be long and severe, or they can be short. And so far, we've seen a nice rebound. We hope that continues, but volatility is unclear at this point, and the implications of COVID-19 on the global economy are hard to plan at this point. So it's imperative that you remain disciplined in your investment approach, not react to short-term market fluctuations, and your team continues to prudently rebalance to maintain alignment with your long-term strategic targets. We'll work with your team to closely monitor your system's risk profile and asset allocation design, And, we think it's still continue to allocate appropriately based on your strategic asset allocation, avoid market timing, and continue kind of on the path that you've set forth as long-term investors. So we feel like your plan's well designed, and despite the short-term implications of a recession, we still feel confident that over the long-term period, you'll be able to reach your assumed rate of return given the asset allocation design. Any questions on any of that?
Yeah, this is Ed. I have a question. There's been a lot of discussion lately because of the given some long-term projections. We know that since 1926, the cumulative returns in the equity markets have been average something like 7 to 8%. But lately, over the last year or so, a lot of people have been reducing their expectations into the 4 to 6% range. Does that factor into any of your calculations or projections?
It does.
Do you go along with that?
So we are very much believers through the end of 2019 anyway, that the next 10 years was going to be much lower in terms of return profile than the 20-year return expectation. So we recognize that valuations were high, both domestically in equities and bonds. And as a result, when you looked at our year-end capital markets assumptions, you would have seen lower expected returns for the next 10 years that then subsequently get higher with some mean reversion over the next 10-year period. So we do subscribe to that view. That said, now that we've experienced the first quarter, I think many people would say that maybe that's less impactful because we have been impacted now by the pressure on valuations coming down quite a bit from where they were at year end. So generally we are aligned at year end, but may have experienced some of that downturn already in the first quarter of 2020. Leroy or Peter, do you want to chime in there or not?
Yeah, that was I should have touched on that on page 6 when I was giving you sort of the caveats for our running the analysis that was there. The one that showed the events. And I should have also said in statistics, statisticians are very well known for saying 3 standard deviation events do occur, even though they're 1%. But in looking at these analyses, there was a sort of endpoint bias to them in terms of our capital market assumptions. And our capital market assumptions, as Sally just mentioned, just came off. That brought the overall level down, and that should have been something that I stressed here. The that goes into these assumptions when you've had a run like what we just saw. And conversely, are negatively impacted. I mean, they were adjusted upward a great amount after we had the December in 2008. Sort of saw a tear between 2018 and 2019 in terms of expectations, but that's something that's factored our assumptions that we review on an annual basis.
Yeah. So, and this is Peter Woolley. Can you hear me? Okay.
Yes.
Great. I guess I would add. I'm getting an echo, so I'm going to pull this out. I would add the comment on endpoint bias that Leroy mentioned. We've actually talked with Mike and Jeff about that as one of the valuable education sessions for a future meeting. We included it as an appendix at first in some of this material and realized it could be a session on its own. There's some real valuable information there. And Ed, to your point, there are a number of things, as Ali mentioned, that brought down expected returns, especially after such a strong year in 2019. Equities rallied very well. The returns were higher than the earnings grew, but also bond yields came down. So for 2 good reasons, you see expected returns should come down. Makita brought those down and collaborated with staff on those projections for 2020. And so we would agree with all your comments there. But Ali mentioned some of that, or maybe all of that, and then some might have played out in the first quarter. We're revising expectations, reviewing them. We've done it once already earlier this year. We didn't publish anything because we thought the markets were too volatile to be publishing numbers that might change in a matter of weeks. And I think that was appropriate. And we're reviewing again at mid-year and might publish some there if we think it's helpful to you and other clients as the market stabilizes a bit. You know, there is a chance that bond yields have come down further, so expectations for bonds would certainly come down. Equities, there's two ways to look at it. One is the building block approach, which would say a premium on top of bonds. So if you look at a fixed premium on top of a lower number for bonds, you would say equities should have lower returns. The flip side of it is a different analysis that's not the building block approach. The approach there would be based on valuations. And with the big correction in equity markets a couple of months ago, our analyses that we didn't publish, you know, were showing that the expectations for equities would be higher returns than we had just published in January because markets were so much cheaper. The big factor that mixes in with all of this is that there is some destruction in value in the crisis that we've seen right now, and so it's not as simple as saying equities are cheaper, therefore expected returns are higher. There's certainly some destruction in corporations, in earnings potential, and in the entire economy, with unemployment hitting almost 20%. Some think it will hit 25% before it starts coming down, maybe quickly coming down to 10%. But 10% is the peak at where we were in the global financial crisis. So how much longer is it going to take for it to come down from 10 to back down to numbers like 3, 4, and 5%? And how much drag does that have on the economy and on earnings? So there are a number of factors that will come together. Some of the biggest ones that Ali mentioned, valuation, certainly would call for higher returns given the correction that happened in the first quarter. The last comment I would make, though, is on the endpoint bias. I think a lot of folks, when they see a correction, it's easy to get more conservative and to say, geez, look at 10-year returns are now a lot lower than we thought they were, and maybe we should revise our expectations. But that's because they're factoring in a minus 34% number into the 1 year, but it also affects the 3-year, the 5-year, and the 10-year number. And that's part of the endpoint bias analysis that we think is a helpful one. It ties in with long-term investing. And we do think it's a helpful exercise to kind of walk through to avoid some of the traps of being overly focused just on certain beginning points or ending points with data. So apologies for the long answer there, but I do think it's a great question and one that we would love to cover in more detail at a future meeting.
Just one further question. Yesterday or the day before, the Congressional Budget Committee came out with their study, which said, in effect, that the damage done to the economy would take 10 years to recover. Is that significantly change any of your projections going forward? Does it lessen it, or is it pretty much the same?
Peter, do you want to?
Could you repeat the question?
Yeah. Yesterday, the day before, the Congressional Budget Office came out with their study, which said the present deterioration and loss of GDP and so forth would take 10 years to recover. I guess my question is, does that change? Is that basically change any of your projections going forward in terms of capital expectations or market expectations, or is this or pretty much have you factored in the deterioration over a longer period of time?
Yes, it's a great point, and that's one that I was touching on, that we would agree, and that's the destruction that I was talking about. That sometimes you have when people talk about the V-shaped recovery, a decline and a quick recovery, that assumes that there's no destruction in the economy and in employment and in earnings ability. And so we're really concerned that there will be. And it might be easy for the economy to get back to 10% unemployment. But if you think about the last time we had 10% unemployment in the global financial crisis, 11 years ago or so, it took us a full 11 years to create 22 million jobs and get from 10% down to 3.5%. So we might quickly go from 20% or more down to 10%, but then it's not unreasonable for some economists to be estimating that it could then take another 10 years to get down from 10% to, back down to 3.5%. And so that, I think there are a range of estimates by economists. That's not a surprising one, and it is one that we're factoring into some analyses that we're doing for expected returns. Did that answer your question?
Yes, it did.
Great.
Peter, this is Jeff. When do you expect, if you publish kind of mid-year?
Lot of reverb.
If you publish those, when do you think that'll be?
Yes, if we did it just a couple of months ago and decided that things were moving so rapidly on a daily, weekly basis that if we shared numbers with you and other clients one week and prepared analyses with you and staff, they could quickly be outdated and not really valuable for presentation to the commission. Fortunately, markets are stabilizing. We are planning another mid-year review, which would be, after June 30th. So I think we'd be looking at a midsummer, more like then if that's a July 1st start time, I think end of July, beginning of August, being able to give you some feedback on what we're seeing and if it's worth, going through the exercise of restating everything, reevaluating things. So I think to pick a date, I'd say August 1st.
Thank you.
Okay.
Okay, are there further questions on this first presentation by Makita, Ali, and the others? Okay, then Mike, are we ready to move to the second one?
Yes, sir, we are.
Okay, I'll turn it back over to Ali then for the second one.
Thank you, Mr. Chairman. So I'm going to start, we're going to present on the Holding Foreign Companies Accountable Act and the potential impacts of our presentation. So I'll start on page 2 with just kind of an overview of what this is. So on May 20th, the U.S. Senate passed the Holding Foreign Companies Accountable Act, which received unanimous consent and was subsequently introduced to the House that day. So the act is intended to increase transparency of foreign companies registered on U.S. stock exchanges, and it's seeking to prevent companies from listing and trading on the U.S. stock exchange if they're unable to prove that they are independent and not controlled by a foreign government. And in addition, companies will be required to allow the Public Company Accounting Oversight Board to review their financial statements and ensure that level of independence. So these requirements will be imposed across all companies and are currently imposed on U.S. companies that are registered in the U.S. stock exchanges. However, Chinese companies are those that are expected to have the most difficult time abiding by these new regulations. And so if you look further down the page, we kind of highlight why we anticipate Chinese companies having a difficult time fulfilling this, but mainly it's because they've routinely cited privacy or national securities as reasons for being unable to provide the PCAOB with the information needed to evaluate their financial statements. And so that has not been preventative historically in allowing them to gain access to the U.S. Stock Exchange, although subsequent to this legislation, it could be. So the potential impacts on the emerging markets index, as you know, China is a large portion of the overall index. And as of April 30th, we used the MSCI ACWI IMI as the proxy based on your simple benchmark to that index to represent the overall equity portfolio. And the emerging market equities make up 11% of that, and China specifically makes up 4%. So the actual impact on emerging market investors is still unclear based on this bill, but it could ultimately hurt Chinese companies registered on the US stock exchanges, which is over 200 firms and makes up a market cap of over $1 trillion in the US. So if this legislation is enacted, it will take approximately 3 years for companies within 3 years, companies will be forced to become compliant with it. And we expect that over this time period, it's likely that you'll see a lot of Chinese companies who may have previously been listed on US exchanges go to alternative exchanges, including Hong Kong and London. We've seen Alibaba, who's one of the largest constituents in the overall index, already successfully list in the Hong Kong Stock Exchange. So they're currently listed on Hong Kong and US. And we're seeing other companies exploring that opportunity as well. So this could potentially have negative impacts on Chinese companies registered here in terms of access. But ultimately, we think it's beneficial because it is going to increase transparency and reduce fraud for US investors gaining access to these companies. We anticipate that, like I said, they'll move to potentially other exchanges. But there are potential ramifications that China is expressing as part of their ability to bargain on this at this point. And so we're monitoring those closely as well. Currently, China is one of the largest contributors to the IPO market in the US, and that has a positive impact on both stock exchanges as well as the investment banking industry. So, we'll see how that kind of plays out. But China is trying to threaten that there could be significant repercussions, including potentially, delisting some of the companies that they have registered. Based on some of the research we've done, we feel as though private sector companies from China will likely remain on the U.S. stock exchange and succumb to the new regulatory environment, which will be great because we'll have that level of transparency and authentication of their financial statements. But those that are more influenced by the foreign government will likely delist or move to a different exchange. Overall, the potential impacts of this on page 5 to your portfolio are relatively minimal. When you look at your current exposure with about 46% targeted to global equities, we anticipate about 0.7% of your overall fund has exposure to foreign companies that are currently listed on US exchanges. And as part of that 0.7%, a total of 0.5% of your overall fund exposure is in Chinese companies listed on US exchanges. So within the context of your overall portfolio, this is relatively minimal. However, it is significant legislation that will likely impact the US stock market as well as US investors' access to Chinese and other foreign companies. So we're monitoring it very closely. And we'll refer back as needed as developments continue to evolve in this legislation. Are there any questions on that?
Yes, this is Bill Condon. And I appreciate the the presentation, as you said, some companies, some foreign companies that are registered on U.S. exchanges may just register in foreign exchanges, delist in the U.S. and move to foreign exchanges. But even now, I assume, based on our investment statutes, we probably already buy foreign companies on foreign exchanges. So the problem that the PCAOB and the SEC are talking about wouldn't the same level of concerns exist on stocks we're buying on foreign stocks that we're buying on foreign exchanges already?
They could, Bill. Yeah, obviously there's certain corporations, just because they're listed, can be excluded, and then you have to figure out how to comply, right? Our current policy, for example, I mean, you could have a company listed in the Middle East that was Iranian, and I don't know if it still is, but it was on the State Department list. So you have to find a way to, not buy those things. But if it's just written as U.S. exchanges, then yeah, I mean, that's not going to really be an inhibitor.
Right. So in April of 2020, the SEC put out a public statement, and they listed 7 risks and related considerations. Only one of them was basically what was presented here, and what we hear most about the SEC and the PCAOB complaining that they can't, in essence, inspect the audit work papers of audits done of Chinese operations. So I think some of these other risks that the SEC tells us that investors have, like ability or inability of U.S. authorities to bring actions in emerging markets. Shareholders have limited rights. Emerging market risk disclosures that these companies in emerging markets, their financial statements may look like U.S. financial statements, but they're not. But they're not always. Look. There's a difference between looking like U.S. GAAP and being synonymous to U.S. GAAP. So yeah, even if we buy in foreign markets, we still have those risk of inadequate disclosures. So I think there's some other issues other than just what the inability of the PCAOB their inability to look at Chinese audit work papers that I'd like to hear about in the future.
Hey, Bill, this is Jeff. Just so I have clarity, are you principally concerned about China, or it sounded like you had concerns that may affect, Norwegian companies or companies located in the UK as well? I just want to help make sure that we're triangulating on what you'd like to hear.
No, a great question, Jeff. Yeah, my first question or bit of information that I'd like is to kind of define the scope of the potential problem of lack of good reporting, lack of regulator oversight, things like that. Because even the SEC says, and again, earlier in 2020, they put out a list of companies that they have problems with accessing audit work papers, and it includes France and Belgium. And it certainly includes Hong Kong and China, those 4. I found it interesting that Sanofi, which is I don't know much about it, but I know it's a biotech company or pharmaceutical company that I hear about. is on this list. So I think it does go beyond China, but I think most of the risk is probably in Chinese companies, but Chinese companies both on U.S. markets, U.S. exchanges and foreign exchanges. I think the scope extends to both.
I would agree with you. From some of the research that we've done, it appears that I've seen companies in France and Belgium and other places that also could potentially be impacted by this. I think that there's a little more confidence associated with their ability to fulfill the expectations associated with the level of transparency, whereas I think there's more of an opposition from Chinese companies. And so that's, I think, kind of why our primary focus as one of the significant impacts would be Chinese companies. But I 100% agree with you that that there could be larger ramifications more globally.
Yeah, I see that same thing too, Ali, that SEC has indicated they're making progress on the Belgium and French issues. But Hong Kong and China are still open. The other thing, and maybe this is I don't mean this negatively by saying self-inflicted, but by us having a mandate, I guess, to a couple of our investment advisors to invest in foreign equities, and we give them the MSCI ACWI as, I guess, as a benchmark or something close to it. We are basically directing them to buy a certain level of Chinese firms, regardless of this risk. So I guess we're just kind of presently just accepting this risk. One of the 7 risks that the SEC listed in April of 2020 was that investment advisors ought to warn their clients about these risks. And I guess we kind of we're just accepting that risk. I mean, we don't need a BlackRock or State Street to tell us about to warn us if we're telling them to just go buy it. So I don't know how much that needs to be discussed, but I guess we're presently just accepting this risk. And I guess that's why I just want to make sure I fully understand it, because if we're just going to accept this risk, I want to make sure I know the full scope of what we're accepting.
Bill, this is Peter Woolley. It's a great topic. We're happy to collaborate with staff with further review and presentation on it. And one thing that relates to our investment policy committee that has convened a couple of times this year to relook at capital market expectations, and we'll be looking at things again at mid-year. We've been meeting more frequently and talking about a number of issues, and one of them touches on this, on the China issue. And China is particularly important also because it's become, over the past few years, a much larger percentage of the benchmark. And to your point, the benchmark lists it, you just accept the risk, BlackRock then just invests in it, et cetera, or other managers. And so one of the topics that we brought up for analysis is potentially considering capping exposure to certain countries like China, because if you're investing in foreign equities for diversification, at what point does it become a concentration and lose the value of diversification if 40% of the index becomes China and 60% becomes China related, countries that are very closely tied economically and otherwise. And so there's no quick answer on that, and we've just begun the discussion on that. But that's something that we're happy to continue the work on, share that with staff, and at the appropriate time share some thoughts there. about how to look at that. There's a few things that come together. One is China's becoming a bigger part of the index. Two, we have, strained and different relations with China, and there's the potential that we have a bifurcated economy and less globalization. And what are the implications then of a diversified portfolio in that? And some of the implications about the review on capital market expectations relates to COVID-19, short-term impacts, longer-term impacts. Some of the things might return to normal. Other things might become a permanent part of the future ways that companies and institutions do business, and that might impact equity, real estate values, et cetera. So there's a lot to unpack there, but did want to say that one of the big things that we are looking at is the China exposure. I think in a very healthy way, but really just from the base level of how much exposure is too much if you're looking at it for diversification.
Hey, Peter, one thing I'd like to add that I hope is responsive to Mr. Condon's, the spirit of his question, is that China has a weight in the global equity market indices that is suppressed in recognition of these issues. So they are not at the weight that their economy is in the global, as a share of the total global economy, nor that their capital markets are as a share of the total global capital markets. So there's been a lot of work done by MSCI, the people who make the indexes, and a lot of thought that's gone into how those indexes are constructed, in part to kind of reduce and manage that risk that they see associated with this and other types of issues. So perhaps it would make sense for us to look to them, since ultimately they design the index. Our goal is not, going forward to have actively managed strategies simply to avoid a small exposure like this. I pointed out we expect we're going to save $40 million a year. I would prefer to make good on that savings and not have to design the portfolio, differently if the potential is, really small for there to be an adverse outcome. So maybe the next step for us is to explore with MSCI how they've approached this in the underlying design of those indices, and then see if there are things we can learn about alternate forms of implementation should we or should the General Assembly decide that we need to invest differently from kind of a generic broad index approach that we're currently favoring. So I offer that as potential next steps and a way to continue this conversation in the future.
That sounds reasonable to me, Jeff. If MSCI has already done some research and maybe put out a white paper on it, or 2 or 3 or 10, that's useful information. And one other question I have, and it doesn't necessarily have to be answered now, but if a large part of the problem stems from lack of regulator oversight of audits of Chinese operations and lack of U.S. regulator oversight, I assume foreign regulators other than China regulators don't have the access either, but lack of access to audit work papers and risk of basically incomplete or fraudulent financial statements. Those same financial statements and audits would be used in debt offerings. So do these same problems extend to our emerging markets debt portfolio?
I can take that. Our EM debt portfolio is, think of that as sovereign, not corporate. So that would be very low sensitivity. There could be, you know, a handful of quasi-government entities in those. I don't know the answer exactly, but I do know that from a benchmark perspective and from a, you know, traditional implementation perspective, you should think of that as lending to the governments, not to corporates.
Okay, sounds good.
Okay.
All right, that one. Sorry, I unmuted the wrong one. It sounds like maybe the next potential step would be to look at getting some either someone from MSCI or some research from MSCI to distribute to the commission or have come talk to us about how they construct the indexes, how they see the risks of these things as the indexes are constructed, and how they attempt to mitigate those risks through the representation of, you know, the various countries that don't necessarily comply with what we would consider to be appropriate standards.
Mike, this is Bill again. I would like to provide to staff and to Makita this April 21st, 2020 public statement from the SEC that just lists the 7 risks.
Sure.
And just so that we don't lose sight of these, and maybe they're going to be the same or substantially the same risk that MSCI addresses, but I just don't want to lose sight of all of these risks here that the SEC sees.
Sure. Yeah, I think that'd be good. Yeah, we can try to potentially frame the questions or how we would ask them to structure their presentation in addressing this. So,
yeah.
Okay.
Bill, I'd appreciate that. It would help us also kind of understand the potential magnitude of risk.
Okay, I will send that to you, if not today, by tomorrow.
Sounds good.
Great. Thank you.
Thank you.
Anything further about the accounting report? Okay, thank you very much, Ali and Peter and Leroy, for your presentation this morning. It's been very helpful to us. And again, I look forward to meeting you all in person, Ali and Leroy, sometime in the future.
As do we. Thank you.
Thank you.
Okay, thank you. The next item of business then is the delegated investment report. And this is just an opportunity to ask questions, since these are investments that have already closed. So do you have any questions of Jeff about the delegated investments during this time period? Okay, hearing none, then that concludes leads to the conclusion of our open session. And before I ask for a motion about that, I'll just tell you my intention is to call for a 10-minute break before we begin the executive session.
Okay. And we're supposed to hang up and call in a different number, correct? Or join?
Yeah, that's correct. You should have gotten a separate meeting invite for that.
Yeah. All right.
All right.
Okay, thank you. So Mike, will you read the motion regarding the executive session?
Yes, sir. 1 second. Sorry, I was Okay. The motion is to proceed into executive session to discuss investment matters and specific investments pursuant to SC Code sections 9-1680 and 9-16320, and to receive advice as needed from legal counsel pursuant to SC Code section 30-4-70A2.
Okay, thank you. You've heard the motion. May I have a motion to that effect?
So moved.
So moved.
So moved and seconded. All in favor, say aye.
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 All opposed, say no. Okay, so we'll resume in 10 minutes. And if anybody, if that's too quick for anybody, just let me know. So it's now 12:15. Let's say 12:25. In that range, we'll resume.
Okay.
Sounds good. Thanks, Ron.
Thank you. And remember to sign back in.